Let's look at sales taxes. A lot of little miscellaneous items in this chapter besides long-term debt. Sales tax and unearned revenue are both examples of short-term. Unearned revenue was covered in a prior video. Sales tax also another example of short-term liabilities, not long-term. Taxes are generally collected by a state or a local government or agency as a percentage of sales. They add to the price of the good or service. For example, sell $10,000 in an area with a sales tax of 10% would have a $1,000 sales tax on top of the price of goods. So the entry is simply recorded as this. We debit cash for $11,000. Let's say they paid cash for this. And we debit sales tax payable $1,000, just like we said here in the problem. And then also sales revenue is $10,000. I need to add that to the solutions. So that's it for this example. All right, so the next example. Dexter Computing sells merchandise for $6,000 cash on September 30th. The cost of the merchandise is $3,900. They're selling, remember? And when we record sales, we have two entries, the sales journal entry and also the recording of cost of goods sold, two different journal entries. Sales tax requires Dexter to collect 5% sales tax on every dollar. And let me reiterate, should they not collect the sales tax, they still owe it. So they sell stuff, they owe sales tax, whether they collect it from the customer or not. So they're like, whoops, we forgot, do we owe anything to the state? And the state says, I don't, whether you collect it or not, I don't care. You owe it. All right, so record the entry for $6,000 sales, the applicable sales tax, and also record the entry that shows the remittance. That is the retailer sending to, for us in South Carolina, the Department of Revenue in Columbia, the remittance of the 5% tax to the state government on October 15th. So here's the sale. Just like in the problem, it said they sold it for $6,000. So sales is credited for $6,000. Sales tax payable is credited for $300. And cash is collected for $6,300. So that's how you record an entry with sales tax. So really the only thing new in this whole transaction is this, that we haven't learned before. And obviously if we have a $300 credit, then the debit or debits, the balance would have to be equal to the total of the credit or credits, right? So $6,300 must equal that one debit of $6,300 to cash. So that should be just what you already know, plus one little new piece of information, which is sales tax. And you should be familiar with that by being a consumer. Most everywhere charges a sales tax. There is also the second entry that, don't forget, it takes two entries. We debit cost of goods sold for $3,900, and we credit merchandise inventory for $3,900. And then on the 15th, we remit the $300 we collected from the customer for sales tax. We remit it and send it to the state. So debit sales tax payable, $300, and credit cash, $300. And that would make this credit to $300 now paid because of the debit of sales tax. We no longer owe it. Warranties. Warranties, another current liability type. GAAP requires companies to estimate material liabilities at the time of sale, therefore matching revenues and expenses. Customers must estimate it using their history and their expectation for the product. And it's not just estimated liabilities. You know the cereal boxes and all these giveaways, they say, hey, do this or that, and we'll send you this shirt or this hat or whatever the case is. Well, if you're going to market that as part of your selling, you need to also set aside an accounting estimate for future liabilities for whatever you're giving away. A lot of people won't participate, some will, right? So on September 11th, Home Store, we really know that's Home Depot probably, right? They just changed it. Sells a more for $500 with a 1-year warranty that covers parts. Warranty expense is expected to be 8% of sales. On July 24th, the mower is brought in for repairs covered under warranty, requiring 35 of materials to be taken from the repair parts inventory. Prepare the September 11th, 2015 entry for the sale and the July 24th for warranty repairs. Now, luckily, they're not asking us about sales tax in this one. So that would be realistic, right? You buy a lawnmower from Home Depot, they charge you a sales tax, okay? So don't think that's going away. They're just not making us do it on this one. Thank goodness. Debit cash, credit sales for $500 to record the retail amount of the sale, and don't forget about the cost of goods sold to record the merchandise being removed from inventory in the subsequent income statement item that needs to be recorded, cost of goods sold. So debit cost of goods sold $200, credit merchandise inventory $200. Now at the time of sale, we go ahead and set 8% of the sales price as a warranty expense. So 8% times 500 is $40. Debit warranty expense and credit estimated warranty liability for $40. And I think that says January. It should say July. I just caught that. On July 24th, they bring the lawnmower in, and they were able to fix it using a part they had in their repair parts inventory. So you want to debit estimated warranty liability for $35 and credit repair parts inventory. Because that part's no longer there, it's got to be a credit to that asset to reduce the inventory balance, and it is credited to that inventory account again, like I mentioned, and it's for $35. That's how you record warranty expenses and then warranty claims. So again, to recap, but not go in, to recap at a very high level, those three that I just highlighted, those three entries are at the time of sale, all on September 1st at the time of sale. The only one outside of that time window is when the person brought back the lawnmower because it was still under warranty. They repaired it using a part in warranty and their repair parts inventory of $35. Oh, and there's no need to go ahead and expense it. We've already expensed it. So in the September 1st, they just hit the liability account. All right. Let's see what we got left. We got contingents, we got bonus, payroll. Yeah, we'll do bonus. Is that what was next? Yeah, we'll do bonus. Quinlan Company offers an annual bonus to employees if the company meets certain net income goals. Prepare a journal entry for the bonus. This is just like a very basic payroll entry. Debit employee bonus expense, credit bonus payable. There's a couple of things to note. They've declared that they're going to pay the bonus, and evidently based on this entry, because it's on December 31st, the bonus is yet to be paid. Sometime in the first of the year, they'll pay it. Okay, but they wanted that expense recorded in last year because that's when it was made. The decision was made, and that's where the decision was made for last year's work. So to properly follow matching expense, revenue and matching expenses, then the expense needs to be included in last year's work because it was a bonus paid for last year's work. So debit employee bonus expense, bonus payables credited December 31st. And again, bonus payable, short-term liability. I think I'm going to call it here. In the next video, we'll start with contingent liability.